What was the government's response to the housing bubble? The early 2000s were a wild ride in the housing market. Home prices soared, and it seemed like everyone was jumping on the homeownership bandwagon. But as we all know, that bubble eventually burst, leading to a major crisis. So, how did the government respond to this situation? First, the government encouraged mortgage modifications and refinancing. They wanted lenders to help borrowers who were struggling. This meant changing loan terms or refinancing mortgages that were underwater, where the loan amount was higher than the home's value. The goal was to keep people in their homes and reduce the number of foreclosures flooding the market. Next, Congress introduced temporary tax credits for homebuyers in 2009 and 2010. These incentives aimed to boost housing demand by making it cheaper to buy homes. This was a strategy to support home prices during a tough time. The Federal Housing Administration also played a big role. They expanded the maximum size of mortgages they insured. This was important because FHA loans typically requiring low down payments. By increasing the limits, more buyers could qualify for mortgages, which helped get the housing market moving again. The Federal Reserve took significant action as well. They lowered short-term interest rates to near zero by early 2009. This was meant to stimulate economic activity. Additionally, the Federal Reserve purchased large amounts of long-term Treasury bonds and mortgage-backed securities. This helped lower long-term interest rates, making mortgage lending more accessible. Government-sponsored enterprises like Fannie Mae and Freddie Mac were also involved. They were required to increase affordable and subprime lending. While this contributed to the bubble, it also became part of the efforts to stabilize the market during the crisis. In 2008, the government allocated over $900 billion for loans and rescues related to the housing bubble fallout. This massive financial support aimed to prevent a deeper financial collapse and stabilize both public and private sectors. By around 2012, these combined efforts began to show results. Housing prices stabilized, foreclosure rates dropped, and home construction started to pick up again. The recovery was gradual, but it marked a turning point from those crisis years. Looking back, the early 2000s were a time of optimism and growth in the housing market. The government's response to the housing bubble was complex and sometimes controversial, but it was necessary to restore stability to the economy after the bubble burst. The era also highlighted the risks associated with relaxed regulations and aggressive lending practices that were common during that booming time.